when you're getting your valuation, timing's important, right? You want to be selling and getting your valuation at a time where you are growing, where you are kicking out profit, because that's when you're going to get the best valuation. You don't want to be selling your company at the point you're burned out, you're done, you're over it, you're tired. That's the worst time to sell a company. So, and the thought of how to value and how to get a good valuation, look at the real estate market, even when it's doing right now, and it's always gone through cycles, but when it's on an up cycle for 7 or 8 years, everyone's like, oh, this is great. You always get this euphoric feeling like this is never gonna end. It's always gonna be good. Yeah. It's not true. Like it does pop, it does end, and it does have downward cycles. So having the discipline, if you're feeling great and your company's kicking out profit, having the discipline to say, you know what, I like doing what I'm doing, and this is a good company, but this feels like a good time to buy. Like that may be your good sense telling you like this is the buy low, sell high time. This is the sell high time, and this is a good time to sell a company.
So let's dive right into probably like the $1 million question. Oh, that's so corny. But like the question everybody wants to know.
Yeah.
But the question everybody wants to know is, how much is my company worth?
Yeah.
I think there's a lot of misconceptions probably around like how that's figured. Like, my business does $1 million a year. Does that mean it's worth $1 million?
Yeah. I think in most people's minds, like that's what gets you to jump off the ledge one way or the other.
Yeah.
Is what's the dollar. And so it is important. As you walk down the transition, it's important. I won't take any of the importance away from that. Like whatever you get to walk away with is important. And there are a lot of things you need to think about that on how you structure a deal, how it affects taxes, lots of things go into it. So, But just talking about the valuation of a company, on average, and of course there are outliers, but on average, a company is worth what they're going for now in our world. The $1 million to $5 million companies, they're going for 3 to 6 times their EBITDA. And that's the bottom line earnings. And a lot of some go for more than that, some go for less than that. It really just depends there are lots of factors that kind of affect that valuation.
So before you go too far into that, just to stop.
Define that.
Define EBITDA. What does that mean?
So it's earnings before interest, taxes, amortization, depreciation, and amortization. I said that. So there might be one other one that I missed in there. But basically, it's your bottom line earnings. And they strip out taxes that you pay because I don't know why you strip out taxes. It's because everyone is taxed at a different rate, I guess. Mm-hmm. But usually that's not in your P&L anyways, your taxes. But interest is stripped out because everyone has different cost of borrowing. Most of these deals you're borrowing to buy these companies, but everyone's cost of money is different. And so you take out the interest, you take out the amortization, because that's amortization. If that's in your P&L, that's like you bought equipment that someone a normal company would capitalize over time. So you bought a truck, you would depreciate that over 5 years or 10 years. So the payments on that piece of equipment, the amortization, the thing that went to actually buying that vehicle is added back into you. And then what other piece of it? And then depreciation is added back. So it's your bottom line. It's at the end of the year, you brought in $1 million. For a gross example, you net $150,000 or $200,000. It's that bottom line that they're trying to get to. And every company's looks a little bit different because everyone kind of runs their financials or their P&Ls a little bit differently. Accounting is something of an art, not exactly a science. It's between the two. So, and a lot of people aren't sophisticated accountants.
Yeah.
I'm not. And so everyone runs their books or their bookkeepers a little bit differently.
Does that in itself present a challenge?
Yes.
when looking at somebody's books?
Yeah, definitely. Because so when they're trying to get to an underlying, what does the owner actually get from this company?
Yeah.
And it's usually in a range for a normal cleaning company of between 10 and 25 or 30%. Again, some go higher, some go lower, but P&Ls a lot of times kind of meet the average in there. Yeah, so some people run their companies completely clean, like all their personal expense is separate from their business expense. More often, people build benefits into their company for tax purposes. So maybe some people would go to Cancun and expense that against the company because it was a business trip, right? So when you're figuring out their bottom line earnings, you'll look at something like that and be like, okay, the company doesn't need to go to Cancun to function. We'll add that back as an owner benefit.
Okay.
Maybe someone took their wife to Ruth's Chris and we're like, okay, the company probably doesn't need $20,000 in meals and entertainment a year, so we're going to add back a piece of that. So there are items in people's P&Ls that will get added back into the bottom line profit.
So really in that equation, you could almost say it's like EBITDA plus, because you guys do take into consideration some of the owner's benefits that are coming out of the bottom line.
Yes. It's EBITDA plus and minus, because sometimes maybe there's no rent in the company.
Yeah.
Because the owner owns the building or has owned it for 20 years. So maybe if we buy a company, we have to rent that facility from the owner. So they're going to get a check from that. But maybe there was $2,000 in real rent that a company's going to have to pay that the owner hasn't been paying on his P&L. So maybe that will get subtracted from the bottom line. But maybe they expensed all their maybe they expensed their kids' vehicles. Maybe they expensed family vacation. So there are lots of things you go through and you normalize. You'll add that back. So a new owner's trying to find out, what do I need that's in this P&L to run this company? Mm-hmm. And what can I expect at the end of the year to get from this company? And that's what they're basing their offer on. What can they expect to get? And so you're combing through the P&L with the owner, usually on a video conference, with the P&L sitting in front of you, and you're going through line by line what stays in here, what gets pulled out of here. So you're trying to normalize what a company can expect to make on that business at the end of a year. And then you're paid a multiple on that. And then usually you're given, well, we can stay on how to value a company before we go through the rest of that process.
So, to kind of run through a scenario for simplicity's sake.
Sure.
$1 million company.
Okay.
20%
Yep.
net. If the normal is somewhere between 3 and 6, that's a huge variance. That's the difference between 600,000 and $1 million too.
Yeah.
What are some of the factors that are looked at that help determine where in the range you fall?
That's a great question. That is the question, right? So the factors you're trying to figure out are varied, but you want to know, how duplicatable is this? Can someone come in and do this? You're trying to figure out how many customers do they have. That's a fact. That affects the ratio, because if in the $1 million company, $500,000 of that was a single customer, then that's seen as a vulnerability.
Yeah.
Like, I lose the one customer, 50% of the business goes away. More than $200,000, right? You're not going to make any profit, probably, if a business loses 50% of its revenue, because all its fixed expenses are kind of the same. So there's a huge vulnerability in paying top line number when you have a single customer. So the question we would usually ask is, is any one of your customers greater than 10% of the revenue of the company? And if it is, then that starts affecting the multiple, because it's seen as a riskier investment. So that's one. Quality of earnings, like what percentage of earnings are they making? A company that's running 5 or 7% profitability may be worth less than a company that's running 18 to 20%.
Even on the multiple scale.
Even on the multiple scale, because you just wonder what's wrong. If a company is running below what you kind of expect earnings to be, then you wonder if there are other underlying problems. If they're running kind of where you would expect it to be based on their revenue, then you're like, okay, this looks like a healthy company. Sometimes that's as simple as pricing. They're not charging enough for their service. So there's that affects the multiple. Is the company growing or shrinking? That affects the multiple. So there's the whole, you want to buy low, sell high in any basic, investment strategy. If a company's whatever way a company's going is where you assume that's the tendency for that company. So if a company is doing $1 million this year and they were doing $900,000 last year, then you're great. The company's growing at 11 or 12%. If it does $1 million this year and it did 1.5 million last year, then you're like, what's wrong? What do I not see in this company? Why are they shedding? Like, why did a third of their revenue disappear? So a company that is growing and continuing to grow and show growth is seen as a healthy company where there's a growing appetite for their services. If it's shrinking, then you want to dig in and say, so that will affect the multiple on a company.
What's the time horizon that you guys are looking? Is it like you look back 1 year, 2 years, 3 years? How far?
Yeah, usually 3 years is what. So when we collect financials, we'll collect the past 3 years, and then a trailing 12 months. So what on a monthly basis. So that's another thing that affects the multiple on. Is it a seasonal company? Does it all of a sudden have big drop-offs, or is it consistent? So consistent revenue monthly, or it's more subscription-based or contract-based, that's seen as more stable and more desirable than a company that's seeing like extreme peaks and valleys and different seasonality. Often it's seen as more valuable to have the consistent cash flow.
So to go back to the first thing that you mentioned, because I think this is a very interesting one because it's not as clear as like, okay, I don't want a customer that's more than 10% of my total revenue. Very easy to understand that.
Okay.
First thing you suggested, though, was this idea that a business is duplicatable. Can you unpack that a little bit?
Well, when I say duplicatable, I guess I meant that it's able to it has the process and the people in place to continue doing what it's doing. So when you're looking at a 3-year trajectory, if they were doing $1 million in 2019, one in 2020, one in 2021, and then 2022 suddenly like they had a $3 million year, you're like, okay, like the mean tells me this company is producing that. Like I need to dig in and understand from this owner what happened here. Did they have this crazy, maybe it was like COVID. Did they have a crazy COVID event? And so it goes both ways. So we would often take the COVID shutdown year and be willing to ignore that if the owner had a compelling argument for why COVID was 50% less than the year before. So we tried to even that out for, okay, we're not going to let this anomaly skew your valuation. But the same could go the other way. Like let's say COVID was a banner year. Like some people had disinfecting the metro in Philadelphia, disinfecting the subway. All of a sudden someone's doing that and they had crazy high numbers. So they went from $1 million average gross revenue to $3 million because they had some just cherry disinfecting contracts. We'd say, okay, that's probably not duplicatable. So I guess that's what I mean is, can you look at it and analyze to the best of your ability, is what we're seeing able to continue to be what we're seeing?
Yeah, I was involved with a company, and because we were selling to contractors in this space, 2021 was such a good year because of the amount of government money that the contractors had access to. They had a flux of cash. And they started making purchases at a faster rate. Now, it wasn't purchases they were never going to make. But what you saw purchases that, like, if you were to take this many machines or this much equipment, and it should have been something they bought over 24 months, they all bought it in a 12-month window. And then the next 12-month window you bring up to this year. and all of a sudden they'd all already bought all the stuff. And it wasn't even that they were out of money. It was just they made the purchases 6 months ago. And so much of it happened that you saw this dip off. And so that's some of the kind of stuff you guys are trying to factor in. You're trying to get the patterns.
That's exactly right. You're trying to put the same thing in COVID with Clorox, right? Like they had these banner years. Well, would you want to have, if Clorox was for sale, would you have want to bought that company after their banner year where they doubled sales? You're like, that's not consistent. And to your point, like everyone bought all this hand sanitizer, all these chlorine wipes or whatever. Now you're like, we have all this inventory. We don't need to buy chlorine wipes for the next 2 years. Well, then that of course affects Clorox's sales for the next 2 years. So you do your best, and sometimes you make mistakes. Of course, they're humans, doing this analysis, but you do your best to figure out how to normalize those earnings.
The other thing that I think was really important, so I'm thinking like the person listening to this, was you also mentioned from a duplicatable standpoint, being a process-driven company.
Yes.
And that's probably a really big thing for people growing their businesses, moving from an entrepreneurial ran company where it's just run on the smarts, the intelligent, the intuition, whatever you want to call it, of the owner, versus more and more of the company runs on a process, and it doesn't require that owner, right?
That's exactly right. Yes. Yeah, so just think about buying if you were buying $1 million company and the owner lived in Hawaii, he lived somewhere else, and that company was running by itself and it was kicking out $200,000 a year, versus you get into a company and the owner's right there, like he's out in the field, he's doing quality control, like he's working in this thing, but it's kicking out $200,000. Like, which one's more appealing to you to buy? Which one makes the most sense? Probably the one that you do nothing. You can be a passive investor and buy this. So naturally that would affect the valuation of a company.
And so when all these factors are put together, like I'm almost imagining like what you're doing on a company is, and for lack of better terms, you can correct me if I'm off base here. It's like you're doing a SWOT analysis of the company, the strengths, weaknesses, opportunities, threats, kind of taking all these things and like saying, all right, where's the company strong? Where can we make more money? And then where's the weaknesses and the threats at? Yes, this is what the bottom line number is, but when you lay it out across these factors, you guys are kind of doing a deeper analysis on it.
You're doing a deeper analysis to get a real bottom line. Even in that example where the guy is working 60 hours a week in his company and it's kicking out the same $200,000. Is the guy going to still be working that hard in the company after you buy it, or is he walking away? And was he paying himself in the P&L? Was he giving himself $100,000 salary, or was he giving himself nothing? So really, you've got to have someone doing that in the company, whatever it was he was doing, and it's going to cost you. So now you've got to put in a salary to really understand what's it going to cost me to run this business, and what does it show at the end of the day. So finding that valuation it's not a one-size-fits-all, but after you go through the process a dozen or 2 dozen times, you get the big items to look for, and you learn how to kind of normalize that bottom line. And most of the guys, after you go through the process, they're like, that made sense. Like, it was pretty clear-cut. We went down line by line. We talked about each line on my P&L. We talked about rent. We talked about salary. After you've gone through that conversation a half dozen times, not a lot of new questions start showing up. It starts being kind of the same thing. But
I think it's a really interesting thing that happens when businesses are growing. Naturally in the early phase, the owner wears a lot of hats.
Yes.
And that's necessary because there's not enough revenue to pay people to wear those hats.
That's right, yep.
But there usually is an awkward stage of the business where the owner believes that they're making a certain amount of money, but they're not paying themselves for the hats they still wear.
Sure.
And they're, and I think this is a good business tactic. I was, when I was taught this, it made a lot of sense to me, was when you look at your own company, whether you're selling or not, you should look at it from a fully loaded P&L standpoint.
Yes.
You should say, all right, well, I need to, if I'm still doing my marketing and I'm doing the books and I'm the CEO, I have to put that on my, I have to put that down.
Yes.
And I have to say, all right, well, this is what it costs to do a marketer. And whether I actually take that out or I can take that out before I determine what my profit is.
Right.
Because I think business owners are like, they're doing all those jobs. Like you said, they're not paying themselves.
Yeah.
But then they're like, oh, my business is kicking out 25% a year. This is a really profitable business.
Yeah.
But that wouldn't be if those 3 positions were filled with actual people getting paid an actual wage.
Yeah. So just think about buying if you were buying $1 million company and the owner lived in Hawaii. He lived somewhere else and that company was running by itself and it was kicking out $200,000 a year. Versus you get into a company and the owner's right there, like he's out in the field, he's doing quality control, like he's working in this thing, but it's kicking out $200,000. Like, which one's more appealing to you to buy? Which one makes the most sense? Probably the one that you do nothing. You can be a passive investor and buy this. So naturally, that would affect the valuation of a company. They'd get paid better somewhere else.
Yeah, and really for a business to be worthwhile owning, it should be able to pay for what it costs to run it and kick out a profit.
Yes. Yes.
Period.
Exactly.
So, and that's what the buyers are looking for. And so I think that's what you have to think about when it's some of this. Could my business run and pay to operate itself and still make it worth someone else owning? Because owning a business and running a business are 2 different facets of a business.
Yes.
And they both have a value associated with them. There's a risk in owning the business.
It's true.
It should be deserved the reward of a profit.
Yes.
And then there's the cost to run the business, which is a skill, time, resource that costs money as well.
That's right. And sometimes, often as you're growing a business, you're going to sacrifice profit to grow. Like you're going to take the, step backward in order to take 2 steps forward. Or you're going to go through a recession. Like in 2008, we did, I think, $2.7 million in 2008. In 2009, we did $1.7 million. But we were at the structure. We were at the $2.8 million structure, and we didn't downshift. We kept all the people. We kept all the overhead. We thought we were being good people. Like you have to do right by your people well, and so the company just bled money. Not only did the company not make a profit and not pay us, we pulled every dime out of our duplex that my brother and I lived in and spent it all that year. Like we were on the verge of broke. We had spent all our cash. Fortunately, in 10 we made money. But all that to say, as you're growing a business or you're going through a business cycle, you may have a bad year or a bad 2 years, and it doesn't mean you don't have a valuable entity, right? Mm-hmm. It may not. You may still have a great company that's going through a bad turn, and so in the valuation cycle, it would have been horrible for us to have tried to sell in 2009. It didn't mean it was a bad company. It was just a bad company right then and a stressful company. But after companies do go through these transitions, and when you're getting your valuation, timing's important, right? You want to be selling and getting your valuation at a time where you are growing, where you are kicking out profit, because that's when you're going to get the best valuation. You don't want to be selling your company at the point you're burned out, you're done, you're over it, you're tired. That's the worst time to sell a company. So, in the thought of how to value and how to get a good valuation, look at the real estate market, even when it's doing right now. And it's always gone through cycles, but when it's on an up cycle for 7 or 8 years, everyone's like, "Oh, this is great." It's never. You always get this euphoric feeling like this is never going to end. It's always going to be good. Yeah. It's not true. Like it does pop. It does end, and it does have downward cycles. So having the discipline, if you're feeling great and your company's kicking out profit, having the discipline to say, you know what, I like doing what I'm doing, and this is a good company, but this feels like a good time to buy. Like that may be your good sense telling you like this is the buy low, sell high time. This is the sell high time, and this is a good time to sell a company. And so we didn't time it perfectly. We should have. In hindsight, we could have held on for another year and made more, but we sold in a better time than trying to sell maybe right now, because their interest rates are going up. Inflation has affected buying power. So all of that affects the price someone can pay for a deal.
Yeah. Yeah. I love the old Jim Rohn adage, you got to think like the ants.
I don't know that one.
Yeah. When it's summer, the ants are thinking about winter.
Yeah.
And when it's winter, the ants are thinking about summer. So whatever the cycle, the season that you're in, it will change. That is the one thing that is guaranteed.
Yes.
And, but that's the opposite of what you see going on around you.
Yeah.
I mean, I think about the last real estate boom, and I remember very, very distinctly going on a vacation to Fort Myers, Naples area, Florida. Right? And it was 2005.
Yep.
And everywhere you went, whether it was the person at the coffee shop or the bakery or wherever you went, everyone was a real estate investor. And everyone was telling stories about buying houses and flipping them for double what they paid for them.
Yeah.
Every condo that had a sign, not even a steel construction yet, just a sign in the yard, was sold out.
Yeah.
People were buying it ahead of time.
Yeah.
And it's that bandwagon effect.
Yeah.
And you got to be careful of it, even in your own business.
It's so hard not to, right? That I love that. I'm not recommending the movie because it had all kinds of mess in it. But The Big Short, you see that Steve Carell one?
Yeah.
Where he goes down to he's like, okay, let's go see how it's selling. And he goes down to Miami and he starts interviewing people and he just walks out and he's like, sell everything you have, like get out. Because he saw that euphoria and he was able to take the pulse on it, but most people can't. And even Warren Buffett, arguably the best investor in the world, he's like, trying to time the market is a fool's game. Like, I don't have perfect insight. I don't have a crystal ball. If I did, I'd be way wealthier than I am now. And that's coming from
arguably the most successful investor that's ever lived.
Arguably. So trying to time a market perfectly is unlikely, but timing it well and getting out on a high is the best time to sell a company.
I think it's important to acknowledge, as kind of wrapping this segment up, that when it comes to your own business, when it comes to looking inward, I think that's when our biggest blind spot is to be able to look at our own, what we're doing, what we've put our sweat equity into, what we've poured so much into, and be able to look at it from a logical, rational state of mind.
Absolutely. We business owners have our blood, sweat, and tears in that business. Like we're heavily invested, and then it becomes a part of your identity as well. And that's a huge part of selling is, restructuring or relearning an identity. Because I am not crystal clean. I am not a window washer, like it's a function I did to pay my bills, or a pressure washer, and it's something that, did well by me, like it was a good ride, but it's not your identity, and that's a hard separation, I think.
I think so too. And I think maybe the advice is it's going to be hard to look at it yourself. I think you need someone from the outside to help you rationally look at these things. Yeah. And I think the thing is you need somebody you can trust to do that. So what advice would you give to kind of wrap this segment up? Yeah. What advice would you give to finding kind of a trusted person that can help look at these things with you and help give you a realistic, rational point of view?
Yeah, I think there are good people out there to do that. I was really blessed to have several great mentors and people to bounce things off of. I've talked to you about my grandpa, who was a Blue Haven Pools guy, and a pastor of ours that was a seasoned business guy. So I think getting good people around you that you trust, and if they're saying all the things you already know, or they're agreeing, because confirmation bias is a scary thing to get locked into, right? You want to hear what people have to say when it agrees with what you see. Like your mentor or the people you look for counseling, some of them better be disagreeing with you every now and then. Otherwise, you've just put yourself in a wind tunnel of confirmation bias and you're not hearing the right thing. So I think having someone that you trust that will gladly disagree with you and voice their opinion is rather important.
Yeah, I like that. I like that a lot. That's a whole subject we could have
a
whole conversation on.
It's important.
The dangers of confirmation bias in our society and the world that around us. But yeah, I think that's great advice. So when we come back on our next segment, I think we'll talk a little bit about kind of the flip side to this is what are some of the proactive things you can do to increase the value of your company and how do you make it attractive to buyers and then how do you find that buyer? So those are some things we're going to talk about. So thanks for watching and we'll be back.
Yeah.